If you pry open the back of a pristine, like 150-year-old gold pocket watch,
Yeah.
you expect to see old brass gears, right?
Right, yeah, like a coiled spring and all those classic predictable mechanics.
Exactly. But imagine carefully taking that gold casing off, and instead of gears, you find, I don't know, a glowing, hyper-agile quantum computer running the whole show.
That is a wild visual.
Well, that is exactly what happens when you look under the hood of Churchill Downs Incorporated, or CDI. Welcome to your custom-tailored deep dive.
Glad to be here for this one. It's a fascinating topic.
Our mission today is to pull back the curtain on this 150-year-old brand. We're using their freshly filed Q1 2026 financial report, their Form 10Q, along with some highly confidential executive compensation agreements.
Yeah, those compensation agreements really show the true wiring of the company.
Oh, for sure. We are going to show you how the company famous for the dirt track of the Kentucky Derby has quietly transformed into a $7.4 billion gaming and intellectual property empire.
And, whether you are a casual sports fan who just tunes in for the big races or an investor studying corporate strategy, this deep dive is going to completely reframe how you look at legacy brands.
Totally.
We're going to explore the hidden and honestly sometimes ruthless mechanics of modern corporate growth and really look at how a company abstracts its value away from, physical dirt and horses.
Okay, let's unpack this, because to really understand CDI today, you have to look past the iconic twin spires of the racetrack and look at the actual engine of their current growth.
Yeah, the dirt track is basically just the storefront at this point.
Exactly. Reading through this Q1 2026 report, the numbers present a completely different picture than what you might expect. Overall, net revenue for the quarter hit $663 million.
Which is huge.
Right, up $20 million from the same quarter last year, with net income rising to $83 million. Now, the assumption would be that traditional brick-and-mortar casinos or like standard wagering services are driving that train.
But they aren't. The biggest driver of revenue for Churchill Downs is actually a segment they label live and historical racing.
And it brought in, what, $297 million this quarter?
Yep, $297 million. And the live part of that title is doing very little of the heavy lifting.
How little are we talking?
Well, Churchill Downs racetrack itself accounted for only about $3 million of that segment's revenue in Q1.
Wait, really? Out of $297 million, the actual live racing was only $3 million?
Yeah. The massive growth is fueled almost entirely by something called historical racing machines, or HRMs.
Okay, right.
They've deployed these across venues in Kentucky places in western, northern, and southwestern Kentucky, plus Louisville and down in Virginia.
So for anyone who hasn't sat down at an HRM, the best way to understand them is to think of them as ghost racing.
Ghost racing, I like that.
Yeah, because from the outside, you walk up to one of these machines on a casino floor, and it looks, sounds, and feels identical to a modern slot machine.
Right, you have the flashing lights, the spinning reels.
Exactly, the instant gratification of hitting a button. But underneath the hood, the engine is entirely different. You are not betting against a random number generator owned by the casino.
No, not at all.
You're actually betting on the complex math of a real, anonymized horse race that already happened. Let's say, I don't know, a random race at a track in 1998. The machine is calculating the odds and the payout based on that historic data.
And financially, utilizing the math of past races is just a stroke of structural brilliance.
How so?
Well, because the underlying event is a horse race, these machines operate under pari-mutuel racing laws rather than traditional casino gambling laws.
Oh, wow.
Yeah.
Yeah.
In standard casino gambling, the player plays against the house. If the player hits a massive jackpot, the house loses that money.
Right, the casino takes a hit.
Exactly. But in pari-mutuel betting, the bettors are wagering against each other in a communal pool. The operator CDI in this case takes zero risk.
They literally can't lose.
Right. They simply take a guaranteed percentage known as the takeout for facilitating the pool.
That's incredible. So they secure the guaranteed low-risk revenue model of a traditional racetrack, but they present it with the user interface and the dopamine loop of a slot machine.
Yep. They capture a massive demographic of consumers who might never step foot near an actual dirt track.
And they do it all without taking on the liability of the house losing to a lucky player.
Exactly. It revitalizes an ancient betting model by disguising it in modern consumer technology.
Which is brilliant.
It is, but because HRMs rely entirely on that specific legal definition, proving that they are racing and not casino gambling, they live in a constant state of regulatory vulnerability.
Oh. And that regulatory tightrope leads directly to CDI's biggest headache this quarter, which we found deep in the 10Q disclosures, the state of Louisiana.
Yeah, the Louisiana situation really demonstrates the fragility of operating in these legal gray areas.
So back in 2021, the state passed the Historical Horse Racing Act, and that allowed up to 50 HRMs to be placed in each off-track betting facility, or OTB.
And CDI moved aggressively on that. They installed roughly 500 historical racing machines across 13 of their OTBs in Louisiana.
Wow, 500 machines.
Yeah, they established a very significant revenue stream. But then a lawsuit materialized.
Because of course it did.
Right. Plaintiffs associated with the video poker and Trek stop industries, which are essentially competing gaming interests protecting their turf, they argued that the 2021 Act was unconstitutional.
And the legal battle dragged on, right?
Yeah.
Culminating when the Louisiana Supreme Court affirmed a lower court ruling.
Yep. The courts decided that historical horse racing was a new form of gaming that hadn't been authorized by prior law.
So it couldn't be conducted without a statewide voter referendum.
Exactly. The 2021 Act was completely struck down. And on May 8, 2025, CDI was legally forced to cease all HRM operations in the state.
See, I'm trying to visualize the logistics of that moment. A judge bangs a gavel and suddenly a billion-dollar company has to unplug 500 cash-generating machines.
Literally unplug them.
That is an enormous amount of physical hardware. I mean, if your entire business model can be outlawed overnight, forcing you to truck 500 machines across the country, isn't this entire business model built on quicksand?
Well, what's fascinating here is how the company responded to what looks like a catastrophic defeat.
Because it does look catastrophic.
Yeah. If you are listening to this, you might assume that a Supreme Court ruling outlawing your main revenue driver in an entire state would be a fatal blow to that segment of the business.
Right.
You're looking at the quicksand, but you have to look at the asset mobility.
Asset mobility.
Think about a traditional brick-and-mortar casino operator in Las Vegas or Atlantic City. Their asset is a sprawling $500 million building.
Right. Stuck to the ground.
Exactly.
Yeah.
If the local gaming laws change and outlaw their operation, that building becomes a massive, worthless liability. They are trapped. But CDI's asset isn't the building. It's the machine and the license. So when Louisiana shut them down, they literally packed up those 500 revenue-generating assets, loaded them onto a fleet of trucks, and deployed them to a friendlier regulatory environment.
Primarily, their venues in Virginia.
Right? Yes, mostly Virginia.
I mean, the disruption is real. The Q1 report clearly shows a notable dip in their gaming segment revenues, primarily driven by that Louisiana cessation. But the fact that they can mitigate a legal defeat by physically migrating the core of their business across state borders almost overnight is wild.
It really is.
They have a level of operational agility that a standard casino operator simply cannot replicate.
It's a highly agile defense mechanism. But, playing state-level regulatory whack-a-mole, moving trucks full of machines every time a court rules against you is an exhausting and expensive long-term strategy.
Sure. You can't just run a trucking company forever.
Right. So to hedge against the exact kind of vulnerability we saw in Louisiana, CDI is aggressively buying up geographic monopolies and untouchable intellectual property.
And we see two distinct examples of this moat building in the recent filings. Let's look at the geographic play first.
Okay.
In August 2025, CDI expanded their physical footprint into New England by purchasing 90% of Casino Salem in New Hampshire for a base price of $180 million.
A pretty big acquisition.
Yeah, but the accounting breakdown for this acquisition in the 10Q is where the actual strategy is revealed. They utilized something called the greenfield method to value the indefinite-lived gaming rights alone at $197 million.
Right, so the greenfield method is crucial to understanding how CDI views its acquisitions.
Explain that a bit.
It's an income approach valuation that essentially assumes you were starting from a completely blank slate, a greenfield.
Okay.
It calculates the present value of the gaming rights by projecting future cash flows, assuming the acquirer has to absorb all the startup costs to build the business from scratch.
Wait, I want to make sure I am grasping the math here. They paid $180 million for the entire existing business, but they are assigning a $197 million value strictly to the intangible gaming license.
Exactly.
They are valuing the invisible permission slip higher than the actual purchase price of the physical business.
They are, and it makes perfect sense when you look at balance sheet protection.
How so?
Well, a physical building, the carpets, the slot machine casings, the roof it depreciates, it requires constant capital expenditure to maintain.
Sure.
But a geographic monopoly, The exclusive right to operate gaming in that specific region of New Hampshire is an indefinite-lived intangible asset. It doesn't need a new roof. It only appreciates as demand grows and competitors are locked out. They are developing the site into the Rockingham Grand Casino, but the physical castle is secondary. They paid for the moat.
Wow. Okay, but here's where it gets really interesting. That covers physical geography.
Mm.
But if you look at the subsequent events section of the Q1 2026 report.
The part covering major events that happened right after the quarter ended.
Exactly. There's an absolute bombshell in there. On April 21st, 2026, CDI announced they bought the intellectual property, specifically the trademarks and rights, of the Preakness Stakes and the Black-Eyed Susan Stakes from an affiliate of First Tee Racing for $85 million.
The historical context of the Preakness Stakes makes this a monumental shift in the sports landscape.
Oh, absolutely.
The Preakness is the second jewel of the Triple Crown. For a century and a half, it has been the primary historical rival to the Kentucky Derby.
The Coke and Pepsi analogy comes to mind, but taken to an extreme.
How do you mean?
Well, it is as if Coca-Cola bought the secret recipe and the trademark for Pepsi for $85 million.
Right.
But instead of shutting Pepsi down to eliminate the competition, Coke licenses the recipe back to Pepsi for an annual fee. Pepsi does all the hard work of manufacturing and distributing the cans, while Coke just collects a high-margin licensing check.
That's a great way to put it.
Because according to the filing, CDI is licensing the Preakness IP back to the state of Maryland for an annual fee so the race can continue to be run.
If we connect this to the bigger picture, the sheer efficiency of the strategy becomes clear. CDI is systematically monopolizing the Triple Crown ecosystem.
By owning their biggest rival.
Right. By acquiring the IP of their historic rival, they gain total control over the overarching brand narrative of the sport's most lucrative events. And they extract guaranteed licensing revenue without taking on a single physical, regulatory, or operational liability associated with running a racetrack in Maryland.
That's just wild. They don't have to hire ticket takers. They don't have to worry about grandstand maintenance, local Maryland zoning politics, or the liability of hosting thousands of people.
Nothing.
They have abstracted the value of the sport entirely away from the physical dirt and the horses, converting it into pure, risk-free intellectual property.
It is the ultimate evolution of a legacy brand. But, when your entire corporate strategy relies on this kind of ruthless agility, abandoning a state overnight, or legally orchestrating the acquisition of a rival's 150-year-old IP, you cannot rely on a standard executive team.
Right, you need a different breed of leadership.
Exactly. You need a team willing to execute a cutthroat playbook with intense precision. And to guarantee that level of execution, you have to engineer their compensation to demand it.
And the confidential executive compensation agreements, specifically the 2025 Omnibus Stock and Incentive Plan, outline exactly how CDI builds those golden handcuffs.
Yeah, the plan relies heavily on a combination of restricted share units, or RSUs, and performance share units, PSUs.
And the distinction between those two tools is really important, right?
Very important. Restricted share units are generally retention tools. They vest over time simply by the executive staying employed with the company.
Just showing up to work, basically.
Yeah. But performance share units, however, are only unlocked if the executive team hits very specific, aggressive financial metrics over a 3-year performance period.
The payout matrix for those PSUs is remarkably precise, too. If the executive team achieves less than 85% of their targeted financial metric, the payout is zero. Nothing vests.
A pretty harsh cliff.
Right. If they hit exactly 100% of their target, they receive 100% of the award. But the interesting mechanism happens at the top end of the scale.
Yeah, this part is fascinating.
If they exceed 120% of their target, the payout is strictly capped at a maximum of 200%.
That cap is a highly sophisticated behavioral economics tool.
See, I struggle with this a bit. I am trying to put myself in the shoes of a brilliant, aggressive CEO.
Okay.
If I am driving the company hard and I hit that 120% metric by year 2 of the performance period, my bonus pool is maxed out.
Right.
I literally cannot earn another dime from those shares no matter how much more revenue I generate.
Right.
Doesn't that structure inherently incentivize an executive to just coast for the final year?
Well, this raises an important question about how corporations manage catastrophic risk.
What do you mean?
Capping success feels counterintuitive, but think about the psychology of uncapped upside. When you give highly ambitious executives an uncapped bonus structure, you are incentivizing them to take massive company-ending risks to artificially pump the short-term stock price.
Ah, I see.
We've seen this historically with companies that collapse under risky bets. If an executive gambles the entire company on a single reckless acquisition and wins, they make hundreds of millions of dollars.
And if they lose?
If they gamble and lose, the company goes bankrupt, thousands of people lose their jobs, but the executive simply walks away.
Wow, so the cap acts as a guardrail.
Yeah.
You don't want them betting the 150-year legacy of the Kentucky Derby on red just to chase a 500% personal payout.
Exactly. The cap ensures that executives aim for steady, sustainable, calculated growth. It rewards the exact kind of meticulous risk-taking we just discussed.
Like the Greenfield valuation.
Right, running a complex greenfield valuation to secure a New Hampshire monopoly, or the surgical acquisition of the Preakness IP. It mathematically discourages reckless gambles while highly rewarding strategic aggression.
And once those executives do execute the playbook and earn those shares, the company makes absolutely certain they cannot take that knowledge to a competitor.
Oh yeah, the covenants buried in these agreements are intense.
Really intense. They include severe events of forfeiture, meaning the company can claw back the compensation if rules are broken.
Yeah, there is a strict 2-year non-solicitation clause post-employment, legally preventing them from poaching any employees or customers.
And lifelong confidentiality clauses covering trade secrets, plus a sweeping non-disparagement clause.
Basically, CDI is applying the same monopolistic strategy to their human capital that they apply to their geography and their intellectual property.
That's a great point.
They lock the top talent in with highly lucrative, performance-based upside, and they lock them out of the broader gaming industry with restrictive covenants if they ever decide to leave.
So what does this all mean? When you step back and connect all these dots, the ghost racing, the midnight truck fleets, the greenfield accounting, and the golden handcuffs, it is clear that CDI is operating on a completely different plane than most legacy sports brands.
Absolutely.
You, the listener, need to remember this. The next time you tune in for the 2 most exciting minutes in sports, you aren't just watching horses run in a circle on a dirt track in Kentucky.
No, you are looking at the public-facing storefront of a remarkably agile $7.4 billion empire.
An empire that navigates regulatory loopholes with historical racing machines.
Physically shifts massive assets across state lines when a local Supreme Court rules against them.
And secures its long-term future by aggressively locking down the intellectual property of its historical rivals.
It's a masterclass in modern corporate strategy.
Which leaves us with a profound, almost unsettling question to mull over about where all of this is heading.
Yeah.
If a single company can successfully buy up the 150-year-old intellectual property of its historical rival and simply license that concept back to a state just so the race can physically happen, what is the actual future of sports?
That is the big question.
Are we rapidly moving toward a world where traditional sports are no longer physical competitions between rival tracks or rival teams?
It really suggests a future where sports are just portfolios of franchised intellectual property, completely disconnected from the physical reality of the game, and owned by a handful of massive entertainment conglomerates.
Because, as we've uncovered today, the real mechanics driving the show are almost never the traditional gears and springs you expect to see on the surface.
Definitely not.
You pry the gold casing off that antique watch, and you find a quantum computer quietly and ruthlessly calculating the odds for the next century.